Morning, everybody. Financial planners. Hope everybody's doing well. As you can see, I've got the no school beard going. Hope it doesn't scare anybody out there. When we see each other again, I'll be clean shaven. I'm going to hold on to this until we're back. For financial planning, just a couple reminders. We've had two assignments that have been posted in Google Classroom. If I remember correctly, we've got about 48 that have submitted the first assignment and about 28 that have submitted the second assignment. I'm not sure why we slowed down, but let's make sure that we get on those. There were due dates associated with those. We are grading this. It is all marking period 4, so I want to make sure you take it seriously. I'm going to change in a second to a document. I'm going to go over some credit card and loan mathematics a little bit later today. You will find another assignment in the classroom, a Google form assignment, all with mathematical questions and problems. Just refer back to the video and I will share the document with you as well. Basically, we're going to have the same math problems that we go over today in the notes, and you can use that as reference to make sure that you get the correct answers. It won't be a lot, just a handful of questions, testing your knowledge on how to figure out some mathematics, because those are really going to be the only defense you have when making a financial decision is looking at the numbers and trying to figure out the math. And it's always helpful to be able to do it yourself, or obviously you can pay somebody else to do it. That's up to you guys. But here's some ways that you can figure some stuff out based on credit card stuff. I've also included the links where I got some of the information to base some of my questions on and some of the math problems on. So I'm trying to make it as real life as possible. All right, so here we go. Starting here at the top. As you know, you have a minimum payment on all your credit cards that you hold. And the minimum payment is about 3% of your balance. That's basically the national average, 3% of your balance. So as an example, I went out and found the average household credit card balance. This is the average balance, is $9,333 per household. Obviously, averages are just that. So many people have more and many people have less. But let's assume you had a $9,333 balance and the minimum payment is 3% of that. So if you multiply that, when you got your statement in the mail or online, you would be expected to send in at least $280. All right, that's the minimum payment. Remember, we learned that sending the minimum payment in is what they want you to do. That's how they can charge you the most interest. You always want to try to pay as much more of the minimum as you can. Ideally, you want to pay the entire balance off every month. Basically, it's free money. But let's say you didn't do that. You send in $280, and then you're all set. Another example here, if your balance was a lot lower, let's say your balance is $3,500. 3% of $3,500 would be $105, so your minimum payment would be a lot lower. So as you use your credit card, you have to realize that the higher your balance, the higher the minimum payment is. All right, let's show you the damage just sending in the minimum payment will do. Back to our balance of $9,300. Let's assume your balance is $9,333. You send in the minimum payment. Your APR is 19.02%. How much interest will you be charged in your account? I got that APR from the link below. That's the average annual percentage rate for new cards as of April 2020. So right now, if you were to go get out a new card, the average is about 19.02%. And that is based on credit rating. So if you have a better credit rating, you'll have a lower than that. And if your credit rating is not as good, it'll be higher than that. So back to our problem. Your balance is $9,300. You send in the minimum $280 before the due date. So you're on time with your payment. There's no late fee. If I subtract the payment that was sent in, the balance after your payment is now $9,053. This is the balance that they can charge you interest on. Again, whatever is left over after you make your payment is where they charge you the interest. So your APR is 19.02%. Remember, that's an annual APR. So to find out how much they charge you every month, we have to divide that by 12. And that gives us a monthly interest rate of 1.585%. And if we move the decimal over, it's 0.001585. So that's every month. All right, every month. So if I go back to my balance after my payment, I owe them $9,053. They multiply that by the interest, and they will add $143.49 to your balance. All right, and here's the killer part. Here's the part that is so disheartening and hurts you. Is here you feel like you sent in $280, so your balance is going to go down by $280. However, because they add the interest in, your balance only went down by $136. So you can see why in a credit card it takes you so long, years and years and years, to pay off a balance if you only send in the minimum. Because here we sent in $280 and our balance only went down by $136.51. So again, the lesson here is to A, pay off the whole balance if you can. That would be zero interest charged. B, pay off as much as you can, more than the minimum. Now, if you're caught in this cycle, what can you do? We had a question on one of our assignments about balance transfers. All right, these are opportunities that people look for. I personally do this. I actually have this card right here that I'm talking about. My balance is a lot lower than the average. And basically I have no interest charge because I do this all the time. There is a fee associated with it. And the question is, should you transfer your balance to a 0% card? So in other words, there are many offers out there where credit card companies say, bring your balance from card A to our card, and we will charge you no interest on that balance that you transfer over. And depending on the card that you find and depending on your credit rating, you can find a card that will actually not charge you interest for a decent amount of time. 6, 9, 12, 15. Actually, I have a card that is not charging me interest on the balance I transferred for 21 months. That's almost 2 years. And here's the example that I have. Here's the example that I use. There's no annual fee on the card. I also have no interest on purchases, so new purchases for 12 months. The interest rate on that card after 1 year will be somewhere in that range. And again, that all depends on how your credit rating is. So you can see the wide range and why it's so important to keep a good credit rating. I have no interest on the balance that I transferred over for 21 months. However, it cost me 5% of that balance to do it. Now, I only transferred about $3,000, so that was about $150. But we're going to use the example from above. Let's say we transferred $9,333 to this new card. All right. The question is, should I do this? Is this going to be worth it to me to transfer this amount of money? So here's the math. Let's figure it out. If I do transfer that $9,333 to a whole new card, it's a brand new card, totally different. So you go from a Citibank card to a Bank of America card, or a Bank of America card to a Chase card, or a Chase card to a KeyBank card. You transfer the whole balance. In this case, it would cost you $466 to do it. All right? So you transfer $9,333. And they add the cost of the transfer, $466.65 to your balance. So your balance went up when you made this transfer. Right? So there's a fee. All right, the balance goes up. Now, on the other side, they're not going to charge you interest on this balance in this card for 21 months. So ask yourself, is it a good idea? Well, if you kept the old card and kept paying the minimum, they would be adding $143 about. It would be a little less every month, but 143, 141, 139. Let's just use 143. They would be adding that amount every month in interest. So basically, in 4 months of not getting charged interest on the new card, you would actually be ahead. Right? Because in 4 months on the old card, you would have added $573 in interest, or about $573 in interest. Transferring only costs you $466. So you can see after saving that interest for 4 months, you would be ahead. So really, you could save yourself about $140 a month in interest for 17 months. Okay? So in this particular case, it would be smart to move that card, to move that balance to a new card. Right? Now, doing this on every single credit card in every situation is not smart. It's going to depend on how much your balance is, what the card offers. Is it for 6 months? Is it for 9 months? Is it for 12 months? What's the fee? Is it 3%? Is it 4%? Is it 5%? What's your balance? What's the APR? Right? All those things have to come into play. All right? If you have a low balance, it doesn't make sense, all right, to transfer, because the fee is going to be more than the interest you would be saving. But if you have a high balance, it does make sense. And if you could find it for a long amount of time. So basically, there are balance transfer cards out there. If you have good credit and you can find one that is 0% for a good amount of months, in my case, 21, that's a ton of time. It could save you hundreds, if not thousands of dollars. All right, this is a little review. We've already done this, but one more time. Loans, loan math. We just did amortized loans. Remember, amortized loans are different than credit cards. Amortized loans, you have payments that are exactly the same every month. Credit card is called revolving credit, all right, where your payments change every month. But with amortized loans, you know ahead of time how much interest you're being charged on that loan. Remember the principal, how much you borrowed. The rate is your APR, annual rate, and the time is how long you borrowed it for. So another quick example. Your principal is $4,500 that you borrowed on a personal loan. The loan rate is 9.5%. Personal loans are usually unsecured, so the rates are higher. And it's 3 years in this example. So I want to figure out my interest. I use the formula PRT, principal times rate times time, and our interest rate, or our interest is $1,282.50. Right? So I borrowed $4,500 at 9.5% for 3 years, and they will add this amount to my loan. So I'd have to pay back that whole amount, the interest plus the original principal. Now, just a reminder, remember that time is always in years. All right, time is always shown in years. So there are situations where you might borrow money for less than a year. So if you borrow for 9 months, don't multiply by 9. 9 months is only 3/4 of a year. So you multiply by 0.75 or 9/12. Right? You might borrow for 18 months. Right? Don't multiply by 18. 18 months is 1.5 years. So the time product, the time amount is always in years. So just be careful with that. All right, back to the example. All right, if you borrowed $4,500 for 3 years and the interest is $1,282, right? Remember that $1,282.50 is the cost of the loan. It's going to cost you that much money to borrow $4,500. So you would be sending back total $5,782.50 in 3 years. Now you make monthly payments, so you would be making 36 payments over the course of a 3-year span. So what's my monthly payment? Well, if I owe them this amount of money, which is your principal plus your interest, and you get to pay it off in 36 equal payments, you would be sending in $160.63 a month. All right, so that's some basic math review. I will include this in Google Classroom so you have reference. Obviously, you have the video as well as we talk about each one of those. As a reminder, every Tuesday and Thursday, we are posting information in your elective classes. So this is an elective, so we'll be posting everything on Tuesdays and Thursdays. In a couple minutes, I'm going to be going to office hours. Remember, every Tuesday and Thursday, I'm available in this Google Hangout. I will forward the link in Google Classroom so you can join me. If you have any specific questions, I'll be happy to answer them. I know these times are tough. I know it's not natural. I know we're not used to it. Try to get into a routine. Check your Google Classroom sites every single day. I will try to avoid posting on Monday, Wednesday, and Friday. Those are for core days, but I will be posting on Tuesdays and Thursdays. So yeah, try to stay in touch. Email me. Anything that you need, I'm accessible. I'm checking constantly. And I'm here for you guys anytime you need it. All right, so hope everybody's good. Hope everybody's healthy. And I hope see you guys soon. It's not the way that we want our year to end, but let's pay attention to what's going on and stay healthy so that we can come back sooner. All right,